Individual stocks versus index funds. Which one's better for building wealth? Most people choose index funds for their simplicity, lower risk, and consistent long-term growth. However, individual stocks can offer higher return potential and the ability to learn about specific companies. Pros of individual stocks. Higher return potential. Picking a winning stock can lead to significant gains. More control. You decide which companies you invest in. Learning opportunity. Stock picking helps you understand businesses and markets deeply. Cons of individual stocks. Higher risk. Your investment depends on one company's performance. Time-consuming. Requires research, tracking, and regular monitoring. Emotional stress. Market ups and downs can lead to panic buying or selling. Individual stocks can be rewarding but are not beginner-friendly unless you're willing to learn and stay disciplined. Pros of index funds. Diversification. Risk is spread across many companies. Lower fees. Minimal management costs compared to active funds. Consistent long-term returns. Historically, markets grow over time. Low effort. No need to pick or monitor individual stocks. Emotional stress. Market ups and downs can lead to panic buying or selling. Index funds are considered one of the safest and smartest options for beginners. Risk comparison. Which is safer? Risk is one of the big differences between individual stocks and index funds. With individual stocks, risk is high because your success depends on one company. With index funds, risk is lower because losses in one company are often balanced by gains in others. For most people, especially beginners, index funds provide peace of mind and stability. Returns. Which makes more money? In the short term, individual stocks can outperform index funds. A single great stock pick can double or triple your money. However, over the long term, studies show that most investors fail to beat the market consistently. Many professional fund managers also underperform index funds. Index funds aim to match market performance and historically, market growth over decades. This makes index funds ideal for long-term wealth building. Time and effort required. Individual stocks requires research, financial analysis, news tracking, and emotional discipline. Index funds can be invested in once a month and mostly forgotten. If you have a busy life, a full-time job, or don't enjoy analyzing companies, index funds save time and stress. Can you invest in both? Absolutely, and many smart investors do. A common strategy is 70–80% in index funds for stability and growth, 20–30% in individual stocks for higher return potential. This approach gives you the best of both worlds, safety and opportunity. Final verdict. So, which one is better? Individual stocks or index funds? Want simplicity, lower risk, and steady growth? Choose index funds. Want higher returns and enjoy research? Try individual stocks.